As a financial planner, I've heard lots of different questions from business owners over the years. In this video, I'll answer the most common questions for you, such as, how should I take income from my business? Are dividends better than a salary? Should I make employer pension contributions? What should I do when it comes to retirement? So, how should you take an income from your company? Most directors of limited companies pay themselves in some combination of salary and dividends, often supplemented by company pension contributions. Finding the right combination for you will depend on a number of factors, such as your company's profits, how much do you want to reduce your own personal tax bill, how much do you want to reduce your company's tax bill, and whether you want to retain certain state benefits, such as the state pension, for example. Often this decision is made in conjunction with your accountant. Firstly, I'll go over the pros and cons of taking a salary from your company. As a business owner or a director, it's a good idea to take at least a small salary. This means putting yourself on the company's payroll. There are several benefits of taking part of your income as salary. You build up qualifying years towards your state pension. You can make higher personal pension contributions. You can retain maternity and paternity benefits. It can be easier to apply for things such as mortgages and insurance policies, things like critical illness cover, for example. You reduce the amount of corporation tax that your company pays, as salary is an allowable business expense. You can take a salary even if your business makes no profit. There are, however, some drawbacks for taking a salary, particularly if you choose to take a large salary. Taking a salary means that both you and the company have to pay national insurance contributions, and a salary also attracts higher rates of income tax than dividends. We'll look at this in a bit more detail later. When it comes to deciding how much of a salary to take, there are a few other points to consider. The personal allowance is currently $12,570. In order to build up qualifying years for the state pension, your salary must be over the national insurance contribution lower earnings limit, which is currently £123 a week or £533 per month. If your salary is above the lower earnings limit, but below the primary threshold, which is $12,570 for the current tax year, then you'll accrue all the benefits of the national insurance without actually paying it. Now that we've covered taking a salary, let's think about dividends. A dividend is simply a share of the company's profits. Profit that's left after a company has settled all of its liabilities, including tax. If there's no profits, then no dividends can be paid. Dividends can be paid to directors and other shareholders according to the proportion of the shares held. There is no requirement to pay all the profits as a dividend or even any of them. A company can retain profits over a number of years and distribute them as the board decides. So, what are the benefits of taking dividends rather than a salary? Dividends attract lower rate of income tax than a salary would, and no national insurance contributions are payable on dividends. By taking most of your income in the form of dividends, you can significantly reduce your tax bill. I mentioned the personal allowance when discussing salaries, but you also have a tax-free dividend allowance in addition to this. In the 2023-2024 tax year, this allowance is £1,000. As you can see from this chart, dividends attract much lower rate of income tax than a salary does. There's also a slightly greater tax-free allowance when you're paid in dividends. Taking your income mostly in the form of dividends may seem like a no-brainer. There are certain limitations and pitfalls to watch out for. For example, relying too much on dividends could make your income unpredictable. Dividends are also paid after corporation tax has been deducted, unlike a salary, which is a tax-deductible business expense. If you accidentally take a dividend that is not covered by profits, you'll have taken out a director's loan, which must be repaid, and dividends also don't count as relevant UK earnings for the purpose of tax relief on pension contributions that you might make personally. That leads me on nicely to the benefits of making employer pension contributions as a business owner. Pension contributions don't add to your income, so they won't increase your tax bill. They're an allowable business expense, which potentially saves up to 19% in corporation tax, and there's no employer national insurance contributions to pay, potentially saving another 13.8% as the employer. Employer contributions are also not limited to the size of your salary. The last point might need a bit more explaining, but essentially as an individual, you're not allowed to pay more into a pension than your salary for that year. So if you're taking a small salary and dividends, as we thought about earlier, then you can't pay very much personally into your pension. Employer pension contributions are not limited in this way. They are only limited by the annual allowance, which is currently £60,000 in a tax year. So this means that your company can contribute up to this amount into your pension each year, even if you have a small salary that we described earlier and take dividends for the bulk of your income. Many business owners often say, my business is my pension, but our view is, why put all your eggs in one basket? It's tempted to put off retirement planning or focus on your business, but the impact of this can be quite significant over time. By postponing or ignoring a pension saving, you miss out on those regular contributions into the pension and the long-term growth of your investments. A pension can allow you to extract wealth from a business tax efficiently, which can then build up over time, which can assist with your long-term financial plan. You don't want to be fully reliant on a business sale for your future retirement, and by prioritising your pension planning early, you can ensure a comfortable and fulfilling retirement. Consulting a financial planner such as myself can be crucial for securing financial stability for yourself and for your business. So if you'd like to discuss your retirement plan, please do not hesitate to get in touch. In conclusion, there's definitely several different ways that you can extract wealth from your business. While both taking a salary or dividends have their pros and cons, and it's important to talk to your accountant on what works best for yourself, you might also want to think about pension contributions and talking to a financial planner. If there was anything that we covered in this video that didn't make sense to you, or there's anything that you would like to be discussed in more detail, please leave a comment below and we'll be in touch as soon as we can. I hope you found this video helpful, and we'll be sure to like and subscribe if you have.